Poker is one of the most important cheat codes in trading. Jeff Yass built a $500 billion trading empire using poker principles. Now, his fund, Sequoia International Group, otherwise known as SIG, is one of the most successful proprietary trading firms in the world. And it all started because Yass was a professional poker player who understood something most traders don't. He now uses his poker principles to train new traders at his own fund. Now, you might be thinking, what does poker have to do with making money in trading? Well, a lot more than you would actually think. Today, I'm going to share 4 poker concepts that Jeff Yass teaches in his fund and why they will make you a better trader. Now, just before that, I'm just going to zoom in here real quickly and change this to a red pen, and let's get straight into it. Position sizing is absolutely everything. In poker, this is called not going broke. Even if you're the best player in the world, if you don't manage your bankroll properly, you'll eventually lose everything. Even as SIG grew to manage billions, they maintained very strict risk controls. They never bet so much on any single trade or strategy that a bad outcome would seriously damage the firm. Now, this sounds very logical and almost silly to point out. However, this is probably one of the most ignored lessons among retail traders. They'll often risk 10, 20, maybe even 50% of their account on a single trade because they're sure it will work. In poker, you don't put your life savings at risk even if you have pocket aces, because 1 out of 5 times you're going to be bankrupt. The same thing applies to trading. Even great setups lose. You have to size your positions so you can survive the variance. Now, variance is going to be a key word during this video, so I'm going to keep on going back to it and kind of hone in why this is so important.
Between bet sizing and trade sizing?
To me, this is like the 2 most important things, especially between tournament poker and trading, are patience and bet sizing. Right? And if you've got pocket aces, you don't want to have your life savings at risk as a 4-to-1 favorite because 1 out of 5 times you're bankrupt. And the same thing goes in trading. There could be a great trade, but I promise you it can always go to a more obscene level. And so you want to make sure that that you're not in a position where if it moves against you more than you think, that you are stopped out, blowing up, whatever you want to call it, where you're done.
Now let's get to lesson number 2. Once we delete this box, it's focus on process, not results. This lesson is probably one of the most important ones for long-term success. You want to develop emotional resilience to variance. Now, what does that really mean? Well, poker teaches you something completely crucial: how to disconnect the results from decision quality. You can make the perfect play and still lose. You can make a terrible decision and actually get lucky and probably win big. As one poker professional put it, you'll experience unbelievable swings of catastrophically bad luck and incredible runs of good luck. The key is maintaining what's called a Zen robotic ability. Now, this is going to be included in the videos I kind of put throughout this video from Bloomberg. They did an amazing piece around poker and SIG, and I'm breaking down the main lessons from it, but also including some videos from it so you can hear it from the source as well. Now, this ability will allow you to focus only on making good decisions. This is typically where most traders fail. They judge the strategy based on the last trade, maybe the last week or the last month, and they abandon profitable strategies during drawdowns and chase strategies that just had a good run. You have to get comfortable with variance in your outcomes. Now, especially for the first year of trading for me, I've been trading for about 6 years now, this was one of the most difficult things to understand because your body naturally would give you maybe some adrenaline right when you won. But if you've made a bad decision there, and let's say back in the day, I risked 20% of my account just on like a random trade, and I won that trade and I made 15 or 20% of my account, that feels amazing. You've just made a lot of money considering your bankroll. But ultimately, that was a completely bad decision. So you have to step out of the result side of things and just focus on, was this a good quality decision? And also a couple other questions that I'm going to answer later in this video.
A lot of parallels between poker and trading. There's the difference between making the right decision and having the right outcome. So even if you made the right decision, sometimes you lose, and sometimes you make the wrong decision and win. Both happen at the poker table and in trading. You have to get comfortable with the variance in your outcomes.
Now, the next lesson, once we remove this, is always know where your edge comes from. Every winning poker player knows exactly which opponents they're profiting from. The same thinking applies to trading. His firm knows exactly where their edge comes from, whether it be superior pricing models, faster execution, etc. They don't just hope to make money. They know why they will make money. And here's the uncomfortable truth. If you can't clearly identify your edge, you might be the one getting exploited. You might be the fish at the table. And I would say this is quite a natural progression for any retail trader, especially in my first 2 years. I was definitely the one, I was giving money away to the market, right? Now, often people will call this kind of like tuition fees when you're especially learning to trade. But primarily at its basic rate, what you are just someone filling up liquidity on the order book, and you have no edge there. So people are basically taking your money blind. And this is a very disheartening thing to hear, but it's a natural part of the process. It's the same way that in any skill, maybe the first year or first couple of months, you'll be the one that's being completely tossed around by everyone that's more advanced than you. But as you progress, then you can start winning over others as well.
I mean, there's lots of similarities between poker and running a hedge fund. In both disciplines, you have to constantly be asking yourself, where does the money come from? Every strategy that we build at our firm, the basis of the strategy is some player in markets that we think is doing something non-economic. So it's not necessarily like they're making a mistake, but they're buying or something for some reason other than, oh, I think this is underpriced or overpriced. And so we just try and build a map and trade around those.
Now, lesson 4 is when you have an edge, you need to bet it. Now, I'm going to deviate slightly from poker from here, just because I think it's a clearer example. But in blackjack, card counters know when they have an advantage when the count is high. And that's exactly when they make their biggest bets. When the count is low or negative, they bet the minimum or walk away. This philosophy carries straight into trading. In trading, this means understanding when your strategy has the highest probability of success and allocating more capital to those setups, or simply just knowing when your strategy actually has an edge, and then that is when you bet appropriately. Most traders get this completely backwards. They often risk more after a loss, simply trying to make back what they lost on the previous trade. I know I've done that many times, especially in my first year. But ultimately, what you want to do is wait for your edge and then size up appropriately.
If you know you have an advantage, if you smell that there's something mispriced, you want to make a bigger bet. Here, even though we're in the middle of the investment, right, we get to double down, okay? And we're going to hopefully get a 10. It's the hardest double down because we're up against the dealer 10. We didn't get everything we needed, and we managed to tie, which is actually okay. So like betting your edge is such a good training ground for this game when you get to Wall Street. Problem with investing in stocks is you don't exactly know if you have an edge. You think Facebook stock's cheap, you think Uber stock's cheap, but you're going up against the collective wisdom of the entire market.
I'm going to leave 2 links to the Bloomberg videos in the description if you want to watch them fully, but I hope you enjoyed this video as well.